And Joe Mazzola and Cooper Howard join me. Joe's head trading derivative strategist, and Cooper's director and fixed income strategist. Afternoon, guys. Joe, what do you think about this ramp here in the last hour?
I mean, it seems like we got a nice little kick save at the end of the day to kind of push us back positive. I mean, look, traded down to the 50-day moving average in the S&P 500 today, and it held. And, you know, we saw some weakness from tech all week. And I think that is maybe starting to bubble over into the surface a little bit. You know, at the index level, it seems like we're still okay. But I know you've had this conversation with Liz Ann before when you guys kind of look below the surface and say, okay, you know, what percentage of the components are actually kind of, 25% lower. And it does seem like it is starting to pick up a little bit. What I've noticed, particularly, Oliver, is, looking at NVIDIA, Bloomberg had an interesting article today where they're talking about kind of the weight of NVIDIA. And if you look at the percentage that it represents in year-to-date returns for the S&P 500, about 30% of the S&P 500 year-to-date returns are strictly due to NVIDIA. So, you saw a little bit of some weakness there this week in that stock, 3.5% pullback yesterday, and then, we had a little bit of a pullback today. And to me, we're kind of walking on that razor's edge with that name in particular. And, if NVIDIA can bounce and maybe push back towards all highs, I think the market's okay. I hate to really talk about one stock, but I mean, when we're looking at concentration like that, it becomes important.
This is almost a ramp that to me looks like it needs a headline or something. It's really impressive stuff, especially because it seemed like there was such a fundamental reason for selling around a bunch of these cloud companies. Look, the first time that you get hit in a while, I guess dip buyers emerge, and we look at Salesforce today up 7%, so we're trying to recover some lost ground. Look, all day basically bonds kind of set the platform for us to do this, Cooper. This morning, yields down, dollar down all day, dollars come back, but bonds have been pretty fixed. Bulls seem to have regained their conviction there.
Yeah, I think that we have seen a little bit of volatility this week, especially on the 10-year, but it's really hugging about that 4.5% level. So I wouldn't be too surprised. We've got to see some data point come out to really kind of force us one way or another. And looking forward, potentially that data point, Oliver, might be next week's jobs report. So we'll see what comes of that. The market's expecting a 180 number and the unemployment rate to hold steady at the 3.9% range. So I think that's maybe the catalyst to kind of push us out of this 450 level that we've seen. But we have been trending sideways for quite a little bit. So
what do you think can move the needle next week, Cooper? We had some pretty big data points, but we've got a bunch next week. Do you think any of them carry as much weight as what we got here with PCE and GDP this week?
I think, again, the labor report is going to be the big one to see next week. I think if we came into this week, looking at today, we obviously got the inflation number with the PCE. But the way I look at it is we came into the day expecting 1 to 2 rate cuts this year. Now, did anything today change that narrative or kind of shift us away from the 1 to 2 rate cuts today? No. PCE came in very much in line with what was expected. So we're continuing with that 1 to 2 rate cuts going forward later this year. So I think that's kind of what we've looked at the data this week. Maybe next week we'll see something. But again, one of the points that we've tried to reiterate and tried to make on this show, Colin Martin, Kathy Jones, my colleagues have said, one data point does not make a trend. So even if we see some slowdown in the labor market, I think we'd have to see more of a slowdown in the labor market to see that really influence what the Fed is likely to do.
Okay. Joe, what do you think about the way bonds and stocks interacted here this week? I guess one could kind of argue this is a late in the day kind of lagged effect, because if I told you that inflation wasn't going to scare us this morning, the bonds were going to rally, you probably would have thought stocks would be up. So I might maybe just kicked in a couple hours behind schedule.
I'm going to take it one derivative past that,
sure,
Oliver. I'm going to look at the move index and just how muted that's been. And I think that's had an interesting effect on what we've seen in the VIX, and just basically any type of tradable volatility has just been really, really muted the last couple months, and it continues to be that way. Even, we pushed back up to above 14 today in the VIX, but last week you and I were talking about 12, right? Heading into the long weekend. So, It's interesting. I think as long as you continue to, maybe trade within a range below that 4.7, 4.8 level in the 10-year, and you find some stability there. And as Cooper mentioned, there wasn't anything in today's report that would really push things around either way. As long as we find some stability within the fixed income and interest rates, and in terms of that volatility, I think we'll probably continue to have some stability within our own equity volatility. Difference being, though, it doesn't mean that we continue to push towards new highs. Probably something along the line of some choppy consolidation around this area.
Seems like 5,300 right now is where we're trying to finish the day. So we got a little over a minute. Thanks, Joe Mazzola. Thanks, Cooper Howard. Have a great weekend, guys.